Welcome to the AU Small Finance Bank Q3FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aseem Pant from IR team. Thank you, and over to you, sir.
Thank you, Inba. Good day to everyone, and welcome to AU Bank's earnings call for the third quarter of FY23. We thank you all for joining the call, and we hope you are prepared. As usual, for approximately the first 20 to 25 minutes of the call, we will have brief remarks by a few members of our senior management team, followed by 30 to 45 minutes of Q&A. Firstly, we will have our MD and CEO, Mr. Sanjay Agarwal, share his thoughts on the overall performance and outlook for the bank. He will then be followed by our ED, Mr. Uttam Tibrewal, who will share his thoughts on the operating highlights for the quarter. Besides them, we also have a few other members of our senior management to answer any other questions you might have. For the benefit of everyone, we would humbly request that the number of questions per participant be restricted to a maximum of 2, and to join back in the queue or mail us in case you have any further questions. With that, I will request our MD and CEO, Mr. Sanjay Agarwal, to share his thoughts.
So thank you, Aseem. Good evening, everyone. Namaskar. Thank you for joining in. Hope you are doing well and had a fantastic start to 2023. The quarter gone by was the 23rd quarter in our banking journey, and another quarter where we have demonstrated consistent performance, and the team has delivered a strong set of numbers on all the fronts. We are on the course of laying a robust foundation for building a sustainable and a scalable bank. In terms of micro, you all know that global economic activity has been slowing down due to the adverse impact of geopolitical tensions, tightening global financial conditions, persistently high inflation, and sharper than expected monetary tightening by central banks globally. Consequently, India continues to face intensified pressures due to the global inflationary trends, weakening global demand, and high volatility in portfolio flows. Specifically, the tighter liquidity and the strong credit growth has led to the increased demand for deposits and rise in deposit rates all across the last quarter. Despite these headwinds, India emerges as a bright spot with GDP expected to grow north of 6.8 this fiscal as per the latest RBI forecast. The effect of series of rate hikes by RBI has helped in bringing down inflation while maintaining the growth inflation dynamics in balance and keep bond yields in check. Moreover, India's favorable demographic, stable democratic setup, and increasing impact of technological innovations like India's tech, coupled with deep structural reforms implemented in the last 5 years, are helping us emerge as a knowledge and technology leader in the world. The governance structure and compliance culture in the country is also growing through a positive change and is one of the equalizers for growth. Coming to AU, the last quarter was among the most consistent and a stable quarter for us. I'm happy to share that we not only delivered the ever highest net profit of 393 crores, but also performed well across all parameters. In line with our expansion strategy, we opened 42 new touch points, crossing the milestone of 1,000 touch points with a presence in 21 states and 3 UTs of India. We ventured into 2 new states, Andhra Pradesh and Kerala, in last quarter. Our deposits grew by 38% on yearly basis and a 5% on quarterly basis, led by an increase in retail term deposits. Our overall CASA plus retail term deposits is around 70%. As the system credit growth continues to be strong, the competition for deposit has intensified with the rise in deposit rates for all commercial banking quarter 3. We also raised our term deposit rates and our saving deposit rates in certain buckets. The overall reception was quite strong in the retail segment, with a clear preference for term deposits, thereby locking long-term interest rates on deposits. In the last quarter, our overall CASA moderated to 38% from 42%, but I strongly believe that it's still in the zone. Our cost of funds saw a 14 bps increase for the quarter as compared to last quarter. As the systematic liquidity continues to be tight, interest rates remains a key variable, and our ability to optimize costs of funds remain a key priority. At the same time, our yearly cost of money continues to be in line with our earlier forecast at around 5.84%. We remain on course to deliver our margins for our current financial year in the line with FY22. Moreover, I strongly believe that cautious stance adopted by us around growth of neither aggressively building assets nor raising more money at higher rates over the last 6 months has served us well, and any impact of elevated cost on margin of next year remains a key monitorable. The credit market remains strong, with strong demand coming across all our assets SBUs, be it Wheels, SBL, housing and commercial banking. The asset business saw a disbursement of north of 10,000 crores, growing 23% year-on-year, with the disbursement yields remaining stable. Our non-fund business also saw sanctions of around 500 crores. Our asset quality, which is one of our core strengths, has remained resilient across cycles, and we are committed to maintaining pristine asset quality. Moreover, we are seeing an increased awareness around customers to repay their dues on time, and there is also a strong momentum in the business resulting in improved collection across buckets and products. Our collection efficiency for the quarter was around 107%, resulting in a gross NPA of 1.8 and net NPA at around 0.51. In fact, asset quality post-pandemic book is even better. 81% of our book was originated post-pandemic, with GNPA is around 0.6%. The restructured book was also seen healthy recovery and now stands around 1.4% of the advances. Our balance sheet has now crossed 80,000 crores. The bank remains well capitalized with capital adequacy around 22%. ROA and ROE for the quarter was around 2% and 15.2% respectively. I think more will be shared by Uttam. Around customers, we welcomed around 3.3 lakh customers last quarter, and with a view to serve our customers holistically, we also expanded our third-party offering by entering a partnership with HDFC Life and ICICI Lombard for the insurance. We continue to invest and make progress in our technology journey. We went live with our upgraded CBS a few days back, which has been in the work for last 10 to 12 months and will provide us greater scalability and resilience as well as new functionalities. Our automation effort also started yielding results with more than 150 processes automated. This will go a long way in cutting our costs. We are also progressing well in implementation of our data platform, which will go live in phases starting in Q4 and improve our data analytics capabilities. On the digital side, we continue to scale up and improve our various initiatives, be it our own app, AU0101, video banking and credit cards. We have around 16 lakh digital customers now, and we have around 4 lakh credit card customers, and our monthly issuance is around now 35,000 cards per month. For our progress, we have awarded the best technology bank and best bank in a digital engagement by the IBA. And of course, it was in small finance category. Throughout the last year, the leadership team of our 9 SBUs presented their business model and strategy at various AU Insight sessions. I hope you would have a chance to interact with our senior leadership and their department to get a deeper sense around the SBU's sustainability and profitability. Our senior team as of now is quite stable, well balanced, and driving the business with a lot of passion, purpose, and pace. We are building the culture of these 3 P's in our organization. In fact, recently we also got featured among the top 50 companies with great managers, and out of that, 3 leaders made our top 100 across the industry. I'm also delighted to share with you that the AU Bank has been judged as Great Place to Work 3rd in a row. We continue to introduce progressive HR practices which are best in the industry with an intent to build this bank where our people not only develop their career but also retire from here. Our recent introduction of ministerial leave for women colleagues and AU Forever Pass entitling our alumni to join us anytime are probably among the first in the banking industry, inspired from our philosophy of Badlaav Humse Hai. Policies like leave for special occasions, paid sabbatical leave, education assistance, subsidized PL and home loan are some of the key initiatives so far. I'm happy to share that we've also been awarded as a certificate of recognition for excellence in corporate governance by National Awards of Company Secretary Institute in the medium-sized listed corporates. To make our governance more robust, I'm also delighted to welcome Madam Malini on our board as an independent director. She joined in today's board meeting only. We look forward to her guidance in building our bank and take her inputs in the area of her specialization like sustainability and CSR. With Malini Madam addition, the total strength of the board has now reached 11 directors, with 9 being independent. But with a heavy heart, I need to also say a bit to our veteran board members, Rafi sir and Jyoti Madam, who are due for retirement in this quarter by March 31st. After a great, long, fruitful and very impactful meeting at AU, which we are very deeply grateful. I have a lot of gratitude for them and will miss them. Last year, we also began our sustainability reporting journey, and I am very happy to present the first sustainability report of our bank, taking you through our journey of care of taking banking to all, now being a catalyst in bringing positive changes to lives of our communities we work with. The report is Global Reporting Initiative based and is externally assured by PwC. I would request you to please go through it and share your feedback with us. In the end, we are nearing 6 years in our aspirational journey of emerging as a best-in-class, highly sustainable retail bank of India, and each year continues to bring new hopes and milestones. We welcome 2023 with great enthusiasm and energy. This year too, we'll continue to leverage the India story and further our franchise business by 3 F's: standardized, scalable, and sustainable. The bank is well positioned in terms of balance sheet strength, distribution, digital properties, stable leadership, and offers a compelling value proposition for customers on both the deposit and the loan side. As we also move ahead, we will continue to strengthen our governance framework, maintain our underwriting and asset quality, invest in our retail liability franchise and digital outlook, build a strong brand, attract and nurture talent, and provide one of the best-in-class experience to our customers. We are also committed to learn and grow every day. So thank you so much for this patience and listening to me. I hand over to Uttam for the operational highlights for this quarter. Thank you so much. Namaskar.
Thank you, Sanjay. Namaskar. Good evening. I'm wishing you a very purposeful and cheerful year 2023. Hope you all are in the best of health. The strength of our foundation and the resilience of our business model is getting reaffirmed every day. And I'm happy to report that we have experienced the same momentum in the current quarter as well, with all our businesses delivering a very strong and stable performance across all parameters. To reiterate, we started the fiscal year with a strong performance in Q1, which probably, in my experience, was one of the best first quarters in the last 5 years. This was followed by a good Q2, helped by an early onset of the festive season, and the festivities continued in current quarter as well. Throughout the first 9 months of FY23, we have consistently excelled across all aspects of our businesses, from deposit growth to CASA growth to improved granularity and stable spreads to strong disbursements and collections. We have maintained a steady course, navigated the ever-changing landscape, while preserving our margins and capitalizing on new opportunities, ensuring that our market position remains unchanged. We will continue to push ourselves to reach new heights and stay ahead of the curve. In the last quarter, we reached 1,000 touchpoints with a branch in Indranagar, Bengaluru. In total, we opened 42 new touchpoints in Q3, taking the total to 1,015 touchpoints, including entering 2 new states, namely Andhra and Kerala. With this, we have now established a pan-India presence, barring North-East region, with presence across 21 states and 3 union territories, out of 28 states and 8 union territories, covering a total of 709 unique locations. I will now take you through some key operational highlights for this quarter. Starting off with liabilities performance in this quarter, our total deposits have now reached 61,101 crores, maintaining the momentum from Q2. We increased our deposit book by 5% despite tighter liquidity in the market. Q3FY23 witnessed an increase in deposit rates across all banks, and we have maintained competitiveness, increasing our deposit rates too. This gave us higher traction in term deposits against saving deposits. Our CASA ratio for the quarter closed 38%, with overall CASA at 23,471 crores, a year-on-year growth of 35%. One of the key target areas for us has been becoming the primary account for our customers, and we continue to design, innovate, and launch savings and current account products to make this transition natural for our customers. The customers acquired in Q3 for our Royal and Platinum savings accounts constituted 24% of the total new saving account customers, excluding DSBTA. Similarly, acquisition in our higher variant current accounts stood at 47% of total current accounts that we opened in Q3 FY23, up from 37% in the previous quarter. In October 22, we launched our AU Platinum Business Current Account designed for retail merchants on the back of merchant-specific inbuilt solutions such as QR, POS, and Soundbox. We have been able to onboard 1,195 Platinum Business Current Accounts till December 22. We are on the verge of launching another premium savings product, which in my mind will be among the best in the industry. This program is especially designed to provide comprehensive banking and lifestyle experience and will give us a strong foothold and market share in the fast-growing HNI segment. With our cross-sell efforts, we disbursed 15,000 plus life and health insurance policies, registered 15,000 new SIPs, and opened 6,500 3-in-1 savings accounts during the last quarter. To further increase in the bank's third-party insurance offerings, we are partners with HDFC Life Insurance and ICICI Lombard General Insurance this quarter. Asset cross-sell has also been an important focus area for us to deepen the engagement with our customer base, and in Q3, we disbursed 589 crores to our branch banking customers across Wheels, SBL, home loans, business banking, and agri loans. With all these initiatives, we are steadily improving product mix to increase our average balances. Our product per customer has been consistently rising and presently stands at 1.62 for saving account customers and 1.99 for current account customers, excluding government and DSBTA accounts. Our digital initiatives, AU 001 app, internet banking, video banking, credit cards, UPI QR, and personal loans have played an important part in improving customer experience and engagement. Our monthly transacting customers have increased to 57% of our total active SAR customers, with average number of monthly transactions increasing to 33. Further, over 70% of the current account customers are regularly transacting with us, with average monthly customer initiative transactions being 75. Through our digital proposition, we added 1.2 lakh new customers, which is nearly 36% of the total new customers onboarded by the bank in the quarter. Today, the aggregate balance in 2.4 lakh video banking accounts stands upwards of 1,000 crore, and we continue to acquire and manage high-quality retail savings accounts through video banking at almost half the cost of a physical channel. We are also happy with the growing digital adoption of AU 0101 app. We now have nearly 1.6 million customers registered on the AU 0101 app, and more than 60% of them were actively logging in December 22. Our credit card proposition continues to scale further with 3.9 lakh live cards and 35,000 monthly card issuance run rate. We have geared up our credit card acquisition through VKYC. In this quarter, we are happy to share that in month of December, we issued 13,000 plus cards via VKYC channel. On the UPI QR front, we have installed 8.7 lakh UPI QR till Q3 FY23 and seen a 33% growth quarter-on-quarter in the value of transactions. I am also happy to share that this quarter we have disbursed personal loans worth 134 crores, taking total disbursements till date to 664 crores, all of which has been disbursed fully digitally on the AU 0101 platform. Moving on to our asset businesses, let me start with Wheels. This quarter, vehicle industry sold 51 lakh units, which is 9% growth year-on-year and 3% quarter-on-quarter. In keeping with the industry upward trends, we disbursed the highest ever quarterly volume of 3,864 crores, 27% higher than same quarter last year, with an IRR of 14.38% and an increase of 9 bps sequentially and an average disbursement ticket size of 4.9 lakhs excluding two-wheelers. As on 31st December 2022, the portfolio of wheels stood at 21,477 crores through 8.17 lakh live loans, which comprise 52% in new vehicles, 36% used and refinance, 10% tractors, and 2% two-wheelers. While personal segment contributed 44%, commercial segment contributed 46%, and tractor contributed 10% to the portfolio. Our average ticket size on the portfolio stood at 2.94 lakhs, excluding two-wheelers. The asset quality of our wheels business continues to improve with gross NPA at 2.22% and collection efficiency continues to remain north of 100%. Moving on to our SBL business, we disbursed a total of 1,678 crores in Q3FY23. In totality, we have disbursed 4,417 crores in 9 months period at a weighted IRR of 14.4%. This is an increase of 63% over the same period last year. The asset quality of our SBL business continues to improve with gross NPA at 2.68% and collection efficiency continues to remain north of 100%. In Q3, we added 6,000 plus new to bank customers, taking the total to 1.81 lakh unique SBL customers. In the same period, our average loan ticket size stood at 11.67 lakhs with LTV of 44%. Talking about our home loan business, we financed 4,400 houses in the quarter, disbursing 547 crores at a weighted IRR of 11%. The total home loan portfolio as on 31st December 2022 stood at 3,695 crores across 37,000 loans with an average ticket size of 11 lakhs and GNPA remaining stable at 0.42%. Currently, we are operating in 8 major states with home loans available across 240 branches. Being an affordable housing book, much of this book is also eligible for long-term refinance from NHB. Finally, on our commercial banking business, it comprises of 4 major divisions, namely business banking, agri banking, NBFC lending, and our construction finance business. Together, they have a portfolio of 11,179 crores at WTRI of 11%. Focus mainly on providing working capital solutions like CCOD and term loans to MSMEs and small businesses. This book is almost entirely a floating rate book and thus the portfolio IRR has benefited from the recent increase in the repo rate. The commercial banking lending business is dominated by business banking and agri banking, which together accounted for 59% of the total disbursement volume of 2,895 crores during Q3 FY23. We also have a strong non-fund based business where we sanctioned limits of 498 crores during the quarter. More specifically, our business banking portfolio has reached 4,370 crores as on 31st December, growing 13% quarter-on-quarter with a disbursement of 1,033 crores in Q3. Agri banking business has now touched the 3,477 to 3,447 crores portfolio mark, registering growth of 14% quarter-on-quarter, with a disbursement of 690 crores in Q3. Our growing footprints in newer geographies, new product initiatives, and increased synergies with branch banking have been some of the key factors supporting these businesses. Asset quality for the commercial banking business remains stable with gross NPA at 0.30%. To sum up, post the 225 basis increase in repo rate by RBI over the last 3 quarters and the increased competition for deposits necessitated by the strong credit offtake, the system-wide deposit rates saw significant pressure last quarter. We will continue to monitor and calibrate rates as per the market environment. Our focus remains on garnering granular CASA deposits and our new product offerings like terminal business accounts and our premium SA offerings which strengthen our existing CASA acquisition franchise. The business momentum on the ground has been strong and we expect the credit demand to be robust in the current quarter. We remain watchful and agile as we step forward with continued on-ground engagement with customers while relying on our strength and processes. I remain confident of our business model and execution capabilities and optimistic that we are well positioned and ready to deliver one of the best Q4. You would agree with me that despite the macroeconomic headwinds and the geopolitical challenges, India has emerged as a bright spot in the global arena. Similarly, within the banking landscape, I believe AU at this stage is at sweet spot, having laid a strong foundation with a well-capitalized balance sheet, sustainable business model, and with strong and stable leadership team. We continue to identify white spaces and position ourselves to take advantage of the possibilities thereon. I look forward to share more with you in the coming quarters. Till then, stay healthy, stay safe, and keep banking with AU. Thank you and take good care. Asim, now over to you for the session.
Thank you, Tanji. Inba, we can now begin the Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take our first question from the line of Rohan Mandora from Q3 Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity and congrats on good set of numbers. So the first question was, we have consumed contingent provisions during this quarter despite healthy asset quality trend and good profitability. So just wanted to understand the thought process of consuming the same and not building the buffers. That's one. Second is, in the last 2 quarters, we are seeing a reduction in employee base. So what's happening there? And third is that currently, what are the challenges in PSLC business? And also, why are we not preferring IBPC route in terms of selling down excess PSLs?
Hi Rohan, this is Prince here. Thank you so much. So, around the first question around contingencies, like as we have articulated earlier as well, that contingencies are precisely created for a particular purpose. And in this case, as you are aware, that it was created for COVID and COVID-related contingencies. Of course, as things are getting normalized, we'll need to resolve those contingencies and we cannot keep on it forever. So if you see in the first quarter, we did utilize part of it to create floating provisions. And the balance, like whatever is around restructure, that's getting used as and when the restructure cases are getting resolved. Either it is getting released to the P&L or getting created towards the NPA provisions for the forward flow from the restructured book, right? As far as contingencies are concerned, very clearly, as I said, we will need to resolve it at some point in time. And we are in discussion with the board and the auditors in terms of their view. And as per their suggestions, whatever is required during the quarter, mind you, we are not taking any provisions to the P&L. What we have been doing is that if you see, we have increased our provision coverage ratios from what we used to maintain about 50% earlier to about 75% now, including technical write-offs. So that's where the utilization is, and whatever is left over at the end of the annual financial year, this is the guidance from the board, we'll take a call in terms of what do we intend to do with the remaining contingencies.
So hi Ron, yeah. So on PSLC, you know that market is subdued, right? In last quarter also, though we tried, we sold around, we issued 2,300 crore in last quarter also, but premium was not there. So we will try in next quarter also. On your question on IBPC, we balance ourselves between IBPC, PSLC and securitization. So as we mentioned in Q2, we sold around 1,000 crore portfolio, and this quarter also 1,200 crore. So it's a balance between IBPC and securitization, and it is kind of tool for our cost of fund also. So we'll see in next quarter also.
Sure. And the third was on that employee base.
Yeah, on the women, on the overall employees and the hiring, it's purely routine. See, I think we had commented this earlier as well, that during the COVID period, there was some amount of excess capacity or buffer capacity which was built in the system, more because people were going on leave and there were 14-day. They were taking time to return, and the counters had to be manned. So to that extent, we had some extra hiring that we had done. But as things are normalizing, as per our own business plan, things are getting rationalized. So there's nothing more to read to it.
So can there be further reduction in employee base incrementally, or are we towards the end of that?
No. I think, we are also, I'm Sanjay this side. So in terms of HR, people around. So I think we already commented that, we're really working on the productivity side. We build a buffer, as Prince commented, but now things have become normalized. And so there will not be any further reduction. Rather, we are hiring extensively. And I think more hiring can be done for the basis of the next year business plan.
Sure, sir. Thanks.
Thank you.
Thank you. We'll take our next question from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations, Sanjay and Nitin, on very good results. Two questions I have. One, if you look at slide 14, the disbursement and the advances yield, they have over past 1 year from Q3FY23 to the current quarter. I understand that this can be because of just scaling of the housing business.
Nitin, your voice is not very clear. Can you just repeat that part? Or maybe just come nearer to the mic.
Nitin, if you are on a speaker or hands-free mode, switch it to handset and speak, please.
Is it any better now?
Management team?
Yes, much better, Nitin. Thanks.
Okay. Thanks. So I was saying, if you look at slide 14, the disbursement and advances yield have hardly moved up over past 1 year. I understand that this can be because of we are scaling up the housing business, but given the extent of rate hike we have seen in the system, this still looks like a little surprising. So if you can share some color on this and why the disbursement yield during the third quarter have gone down over the second quarter. Very marginal decline, but any reason behind that? And the second question is on the collection efficiency. Now we have been reporting for many quarters in a row, we have been reporting collection efficiency of more than 100, this quarter being 107. So how long to expect this, and what is really driving it? Is it like the back book areas are higher, which is driving this, or is it like a prepayments which are coming through to drive such high collection efficiencies? And any color on these questions, please.
So Nitin, I'm Sanjay this side, so I'll answer the second one, right? So, I would say that, the credit compliance or the culture, I already commented in my speech that it is one of the best time for us as a lender. People have become much conscious around even borrowing money, and, the whole repaying their EMI on time has come to be, some kind of discipline, some kind of culturally people has become more disciplined around it, right? And this I'm saying across products, across geographies, across buckets. So that is why the recovery percentage or the collection is north of 100%. And and the kind of business momentum we are seeing, and the kind of the exuberance in the customer we are seeing, I strongly believe that this year at least, I'm saying the next financial year, 2024, I would be surprised that it drops. So that's my sense. So I think you will see this kind of same asset quality maybe for long time now. I can't comment or explain the long time, but the way after the COVID we have seen our gross NPLs coming down and the collection efficiency remains so strong. I have more hope than a worrisome aspect around it, right? So that's on the collection. I hope I answered your question right.
Yeah.
And, what your early one is around the disbursement, yeah. So can you finish?
Hello?
Management team, are you still connected? There seems to be no response from the management line. Ladies and gentlemen, we request you to please remain connected while we disconnect and rejoin their connection. Please hold the line. Ladies and gentlemen, thank you for your patience. We have reconnected the management now, and Ms. Agarwal, I've unmuted your line as well.
Okay.
Nitin, you're still there with us?
Yeah, I'm here, please.
Yeah, so sorry about that. So if I understand clearly, your question on the first part had two parts, right? One was that the disbursement overall on a year-on-year basis looks flattish, right? On an overall, what we have given on slide number 12.
Yeah, yields have not gone anywhere year on year, and this quarter the yields have come down on disbursement.
Yes.
These two parts. Yeah.
No, sorry, yields have not gone upward year on year?
Yeah, from 12.7 to 13. And this quarter it has moved from 13.1 to 13.
Little actually for this quarter, this was festive quarter, right? In October, this was Diwali festive. So because of that, in that particular month, you get business. So yield was slightly lesser than last quarter Q2.
Very marginal, and the decline is only 5 basis, and that's also partly because the mix of the commercial banking has increased slightly. Our yields otherwise have held up, if you talk about the retail.
Right. So can I assume that we have been able to pass on the rate hikes that we are seeing in the system to the customers at incremental level? Because the yields otherwise are staying flat otherwise.
Yeah, I mean, on the vehicle side, very clearly there has been a pass on, and as I think Uttamji also articulated in his speech, there has been a 9 basis of sequential increase in terms of as yield disbursements. Of course, the banking book, if you see the overall yields have jumped up significantly, given that they are floating rate and repo linked. In terms of SBL, it is broadly flattish, but again, you'd agree with me that that book is already at a slightly higher yield. So yeah, I think not really worried too much in terms of passing on the incremental cost.
Right.
So if you see the slide number 13, our NII is almost same in last 4-5 quarters.
Yeah. I can see that. Yeah. And just a follow-up on the other question that I had around collection efficiency. So with collection efficiency being more than 100%, does it imply that we are recovering from the back dues, or we are having prepayments? Or can there be any other reason?
It's across buckets, as we said in our commentary. So it's also on loans which are way past due, where we have been able to recover now because business activity has sustained and.
So our collection efficiencies don't include prepayments within, as we have disclosed. So this is primarily, and I think we have also articulated that what we saw this quarter was some very strong collections both across buckets as well as across products. So that in some ways signifies that the underlying cash flows in the underlying businesses has been very, very strong.
Right. Okay. Got it. Thank you so much. I wish you all the best.
Thank you. We'll take our next question from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, hi. So my question was around the cost of funds. You have obviously made detailed disclosures on incremental and outstanding cost of funds. and they've not moved much if you compare it to most other banks that have reported. More importantly, if you just calculate from balance sheet averages, then cost of funds have risen much less than even what you disclose, obviously, because you disclose on, daily balances. How is it that relative to the system, you've fared much better on cost of funds despite hike in savings? And what is the outlook for fourth quarter and longer term, just in terms of cost of funds or cost of deposits? That's my first question.
So, Mahrukh, first of all, we haven't done any CDs, right? As in this quarter, as we have disclosed, our CDs have in fact been coming down. Now, as far as the overall cost of funds is concerned, we would agree that our cost of funds were quite high when we started the bank. It was around 5.95%, unlike some of the larger peers that you are comparing us with. And we have benefited from some of the repricing on that book. Now, of course, if you look at the incremental cost of fund, I think that has, as we have disclosed, it's about 23 bits up in this quarter. And that is in line with the broader industry. So I don't think there's too much to read there.
Okay,
and secondly, it was mix of our funding rate, like we did securitization and we raised low-cost refinance also, which helped in our cost of fund, overall cost of fund. And in terms of Q4, I think, as we mentioned, that we should be within range what it was last year, overall year. It was around 5.95, so we expect that we should be in that range only. And for next year, very difficult. We are also reading the market. So as we mentioned in our commentary also, that this is key monitorable for us, and we'll see with the time. Right?
Got it. That's helpful. And my next question is on the ECL circular. Also, have you been filing mock runs with the RBI? And obviously, your provisions, you've given a detailed slide on your provision to AUM, first in excess of 2%. Given that, do you see any major impact from IFRS on your books? I mean, any comment that you can give on the IFRS circular?
Yeah, so Sanjay this side. So, again, this is just on paper in this, and it just recently came, right? So it's difficult to comment as of now because once the overall scheme of things are settled down. But of course, we are filing with RBI, and by that, we have a positive impact than a negative one. And so I strongly believe that once it is implemented, it will have a neutral to positive impact on us.
Sure, and why is that so? Because of early provisions on certain buckets, or what is it? Like, if you could just...
Yeah, so you know about that. We provision so much, and our net credit loss is very less. Secured book, right? Yeah, of course. That's why we have an NCL is less, right? So I think you're absolutely right, because we provision more than what it requires, but just to make our balance sheet stronger and stronger. So, but in ECL, you have to just estimate, right? So I think this is that. It has neither to positive impact.
Okay. Thank you so much.
Okay, thank you.
Thank you. Our next question is from the line of Ashlesh Sonjay from Kotak Securities. Please go ahead.
Thank you. Congratulations. Just a couple of questions from my side. Firstly, a follow-up to one of the previous questions.
Mr. Sonjay, I'm sorry to interrupt. If you're on a speaker mode or hands-free, please switch to handset and speak.
Hey, hi. Is this better?
Yes, thank you.
Hi. So, hi team. Congratulations. Firstly, a follow-up on one of the previous questions. On the cost of funds front, has there been any rundown of any older, higher cost borrowings on our book? And if yes, how long do you expect that to continue?
No, so we don't have any grandfathered borrowing, right? Right, but that has already been closed. This is now 6 years running. So 3-4 years we had those grandfather borrowings. So this is in normal course of business. Yes.
Okay, perfect, sir. And secondly, on the TD front, on the term deposits, there has been a decent traction on the retail as well as bulk TDs. They're up by 10 to 15% quarter on quarter. Can you share the blended cost of deposits on the bulk TD book?
Rishi, can you answer this? So, yeah, what's the question? We need a blended cost of
the TD, bulk TD book.
So my bulk TD cost is around 6.4 in 9 months for this year. Means overall TD cost I am telling you, fixed deposit cost.
So this includes both the retail as well as bulk TD?
Retail and bulk both.
Okay. Is it possible to bring out the bulk TD cost separately?
So, Ashlesh, I think we have commented earlier as well that typically we don't prefer, bulk TD. I mean, we have been articulating that there has been an internal drive to go more granular, more retail. And what we are measuring right now is CASA plus retail TD index, which you would see is now about 70%. So honestly, on the wholesale side, we generally prefer to give lesser rate as compared to retail. And on the retail side, we generally have a slightly higher markup. So while we don't disclose this number independently, but if you ask me, it should broadly be similar or slightly lesser.
Okay, perfect. Thanks. And just one last data keeping question. Have we hiked the interest rates on new loans in the SBL book this year so far?
Sorry, come again?
On the SBL book, have we hiked interest rates on new loans during this year so far?
Not much.
Okay.
It's still on a very higher rate of interest book. So it's a very long-term book. So we don't want to push that rate on a higher side.
Yeah, perfect, sir. Thanks a lot.
Yeah.
Thank you. Our next question is from the line of Renish Bua from ICICI Securities. Please go ahead.
Yeah, hi sir, and congrats on a good set of numbers. So sir, my first question is on yields on the business banking side, which has been up by almost 100 basis points.
Sorry to interrupt, could you please speak on a handset mode?
Yeah, I'm on handset only. Is it better now?
Yeah, thank you.
Yeah. So sir, my first question is on the business banking yields. So, the yields on the business banking side has been up by 100 basis points. I understand that it's a floating rate book, but if you can help me with the reset period, and what is driving this, hike? I mean, are we able to pass on the hike, or there is, let's say, different set of customers we cater to, wherein large banks are not there?
Yeah. So this is Vivek here. The entire business banking book is linked to the repo rate, and it's a quarterly reset. So, any rate hike which is there is passed on the next quarter. So every 90 days there is a reset for each contract.
Okay. And then in presentation, what we disclose is the disbursement yields, or it's the blended yield?
No, I'm saying the portfolio yields have gone up because it was the entire book is linked to the repo rate. And even in case of incremental business, what we are doing, we are sourcing at an incremental higher rate, right? Because the overall regime has changed. Even the competition has increased the rate, but obviously not to the extent that what repo rate has been increased, but there is a significant rate hike on the new acquisition.
Okay, got it. And sir, so my next question is on the bit of clarification side. So one is on the AD1 license. So I mean, I know we have applied, but would you like to comment on the status of that? And number two is on the RBI divergence report. I mean, does the audit had concluded, and what's the outcome of that, if any?
I think so. On the divergence side, because we haven't published anything, so that should be taken that the RBI the report is well in place and is in the shape.
Okay.
And your other one, the AD1 license, yes, we applied in the month December, and we are waiting for that. And of course, the regulator has to decide, but we has applied for that.
Okay, and any timeline? I mean, historically, any evidence within what time we get?
Sorry, we can't comment on that, but it generally takes maybe around 5 to 6 months. So generally takes, right? So it's a general statement, not specific to us. So, and we're planning in December.
Got it. No, this is helpful, sir. Thank you very much, sir.
Thank you. Our next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So last quarter you sounded a bit cautious on growth front, citing that deposit cost has gone up. What is our stance on outlook on growth now? And going into FY24, what is our outlook on growth?
So last time also people read more into that, but if you have seen our growth in quarter 3, it is absolutely in line what I commented. And because it's not about only an asset growth, we need to see how deposit is being built, at what cost, at what tenure, at what rate, So I think we want to play a very balanced role because we really want to build a very sustainable bank without any noise in any quarter. So I strongly believe that quarter 4 is always better than quarter 3, right? And we are absolutely on track. What I commented or promised as a team from quarter 1, we are supposed to deliver that. And I would say we are on track because our profit is growing north of around 27-28%. Our asset is growing north of 27-28%. Deposit, we are playing a very calibrated game where we don't want to borrow at higher rate. So we want to be mix of them. Our digital properties are doing well. The SBs are performing well. We are building our governance structure. Asset quality remains strong. So I think overall we are very happy the way we are building ourselves from last 9 months. It remains very tough because the kind of interest rate cycles has gone up. We still managed to manage our cost of money at around 5.85. So in that sense, and now another 75 days for this year. So you will see the result by April 1st or 2nd. So overall, I would say I'm very happy that the team has come together, has navigated these challenges with the flying colors. So very optimistic about our future, but need to take call every quarter. And because it's a very balancing game, right? You can't comment or you can't be over aggressive or you can't be just look for a growth at any cost, right? So we have learned hard way. So want to remain very cautious but very optimistic.
Sure. And secondly, our share of unsecured has increased to 7% of the book, which was quite negligible 3-4 years back. And we have always focused on secured segment. So what is our strategy on the unsecured? At what percentage we will be comfortable with? And I see that the large part of unsecured has been driven by credit card book. So if you can also share some comments on the asset quality and credit cost in that part of the book. We are the last two.
So again, absolutely. So unsecured book has 3-4 linkages where we do from credit card, we do straight to our existing depositors, and we also want to build something around the commercial customer for QR code, right? So everybody is building their business. We are in a very nascent stage, Overall, we don't have any significant numbers around it. So I would want to wait for maybe 2-3 quarters to really comment on the quality of asset, on the size we want to pursue around it. So I think it's very early for us to comment on anything, to be very honest. So give us some time in maybe 2-3 quarters to really spell out our strategy around this unsecured. But I think as an organization, we are very happy that we are driving all those opportunities, whether it's through QR code, through credit card, through your data analytics on your existing depositors. So it's we are not running that program on FOS. It is more through digital, data-driven kind of story. So give us some time, then we'll comment more on this.
Thank you. Thank you.
Prince here. This Prince here, just to add, and on that specific 7% number, not all of it, I mean, while it's classified as unsecured, but bulk of it, like on credit cards, again, as the portfolio is growing,
It's mostly the out of pocket that we have at any point in time, depending on the spends in the particular month, right? Not all of it is actually a loan, so to speak, right? That, I mean, it doesn't revolve. On the second part, there is a decent chunk of SBL book there in that 7%, where, for various reasons, the collateral might be imperfect or in the process of getting perfected. And because of that, it's classified as unsecured. But if you look at the core business-wise, it's not really unsecured.
Yeah, so 1,000 crore number that you disclosed in the credit card, isn't it revolver or?
Sorry? The 1,000 crore is the out of pocket, not the revolver.
Not the revolver. Okay, got it. Okay. Thank you.
Thank you. Our next question is from the line of Hiral Desai from Anived Portfolio Managers. Please go ahead.
Hi, Sanjay. Good evening. Am I audible?
Yeah. Yeah.
Yeah, so if I just club, what Mahrukh and Nitin asked earlier, so just wanted to get your thoughts on margin, over next, let's say 4 to 5 quarters. Because if I see the incremental spread, they are about 70 basis points lower versus the back book. And the deposits might continue to get repriced at least for next couple of quarters. So wanted to get your thoughts on margin actually for next probably year or so.
So again, I would say it's difficult to comment now because again it's a evolving story that what type of interest rate cycles we are all expecting. My sense is that we are nearing to an end to a higher interest rate regime, maybe one more or maybe not more than two. Our inflation is in now control. We are moving as an economy. So as I already commented that bank is about balancing so many things. It's not only about names. There are so many other things, right? And every year something plays out. Like this year, there's no treasury, no PSLC, but
right.
We are still able to manage our names and other incomes from other sources, right? So right. I would rather want to comment on this by next call, because then there will be lot much clarity on many tendencies around us, and also how the whole year would be looking in terms of interest rate and all those things. How we really play our quarter 4 also in terms of our disbursement yield. And so I think it's more around evolving story as of now. So give us some time. But as I already commented that NIMs are just one part of the whole balancing, right? As a bank, we remain very strong. We know from where the deposits should come. We know how to lend. We know how our assets are behaving. We know how we are building our team. How the SBs are performing. So I think those things are more for me as a CEO are more important because
right.
Interest rates are more transitory, right? Maybe 1 year we might have 1% less ROE. But as we always comment that, AU is here for long term, forever kind of story which is built on scalability and sustainability. So for me, that is more important, right? And I'm feeling very much confident by passing every quarter that we are building more and more good foundation for that huge building on it.